In the last 48 hours, the Fed's vice chair, Philip Jefferson, used two words that matter: cautious optimism. And the policy rate is still in the 3.50% to 3.75% range. That pairing tells you what markets are waiting on. This is education, not financial advice. Here's the promise. By the end, you will know what data reopens cuts, what data delays them, and three simple signals you can track this week. Now, picture one anchor. Sunridge Homes is a mid-size builder using a floating rate bank line. Every quarter, they decide how many homes to start. Their spreadsheet does not care about vibes. It cares about the path of short-term rates. What happened is the Fed did not give a date. They gave a condition set. Jefferson's message, as reported, is that adjustments depend on incoming data and risks, while the job market looks like it is stabilizing. So, the base case is steady policy, not a sprint to cuts. Here's the first receipt moment. In the Reuters report, the range is still 3.50% to 3.75%. And the tell is, depends on the data. That is the line the market trades. This looks like cuts are coming, but it is actually show me the prints. That contrast is the mechanism. Markets do not trade today's rate. They trade the expected path. So a shift in language is a shift in probabilities. Step one is inflation progress. If inflation cools cleanly, the Fed can ease without losing credibility. Step two is the labor market. If hiring weakens materially, pressure rises to cut. Step three is financial conditions. If markets loosen too early on hope, the Fed may wait longer. Put simply, the Fed is trying to avoid easing too early. One reasonable read is they are guarding against a second wave. If markets loosen on hope alone, demand can reheat. That shows up first in services inflation and wages. So, the Fed uses language as a brake. It tries to keep expectations anchored before the data forces action. For Sunridge Homes, this is not abstract. Their floating rate line reprices fast. If cuts get pushed out by months, their interest cost rises this quarter. That changes how many crews they hire. It changes what they bid for land. Now, two things often get confused. A pause is a hold with optionality. Easing is an actual decision to move. A common misread right now goes like this. If the Fed says the job market is stabilizing, cuts are automatic. But stabilizing is not the same as cooling inflation. And the Fed's own language is the receipt. Data dependence means they can hold longer if inflation is sticky. The first place you see that is the front end of the curve. 2-year yields react to how many cuts, how soon. If cuts get delayed, front-end yields can reprice higher. Then the dollar can firm versus peers that are already easing. Then equities reprice through the discount rate, especially long-duration growth. In plain English, a no-rush-to-cut world keeps borrowing expensive. There is also a quieter channel: credit. When short rates stay high, refinancing gets harder for weaker borrowers. Spreads do not need to explode to matter. A slow drift tighter in bank terms can hit activity. Back to Sunridge Homes. If their bank expects rates to stay high, terms can tighten. A higher spread over the benchmark, more collateral. A lower line limit, Sunridge can still build, but each unit carries more financing drag. What makes this a real news story, not a generic Fed explainer, is the timing. Markets keep trying to front-run the next cut. And it lands after late January Fed communications, where the broader strategy language did not change. Here's the second receipt moment. The Fed reaffirmed its strategy statement in late January. So, when Jefferson says data and risks, it is consistent, not a new regime. Treat it as probabilities being marked to new information. So, what could break next? Not stocks crash. The first pressure point is credit sensitivity. The longer the pause lasts, the more refinancing math bites. You tend to see it first in rate-sensitive pockets. If this continues, you would expect stress to show up as pockets, not one headline. Now we get practical. You only need 3 signals to track this story. Signal 1 is the inflation trend. Where to look is the official inflation releases, like CPI and PCE. What direction matters is whether core inflation is cooling again or re-accelerating. Typical lag is monthly, and markets react the same day. Signal 2 is the labor market. Where to look is the monthly jobs report and weekly jobless claims. What direction matters is sustained slowing in hiring and a drift up in unemployment. Typical lag is weeks to a month. Signal 3 is Fed path pricing. Where to look is Fed funds futures, often summarized by CME's Fed Watch. What direction matters is whether the market pulls cuts forward or pushes them out. Typical lag is immediate. Put simply, those three signals are your dashboard. Now, the stakes without drama. Over the next 24 to 72 hours, this is a messaging trade. In the next 2 to 6 weeks, a couple of prints can shift the cut path fast. If this persists into spring, high real rates keep pressure on credit-sensitive sectors. For Sunridge Homes, those horizons are real. Next 72 hours, their CFO watches futures pricing. Next month, they watch mortgage rates and buyer traffic. If high rates persist, they slow starts and renegotiate land options. One more misread wrecks intuition. Cuts are always bullish. Not always. If cuts come because growth is breaking, risk assets can still struggle. The cause of the cut is as important as the cut. In plain English, cheaper money can arrive with a worse economy. In the next block, we walk the mechanism forward. We map how each print changes cut odds, and how that spills into the dollar, credit, and stocks. And we keep coming back to Sunridge's spreadsheet, because that is where macro becomes real. Start with the cleanest way to think about this. The Fed is running a checklist, not a calendar. The checklist has 3 lines. Line 1 is inflation momentum, not the headline print, but the trend underneath it. If the trend keeps cooling, the Fed gets room. If it stalls or turns up, the Fed gets trapped. Line 2 is labor stability. If jobs stay firm, the Fed can wait. If jobs crack, the Fed has to weigh downside risk. Line 3 is financial conditions. If markets celebrate and borrowing gets easier, the Fed may slow down. If markets tighten on their own, the Fed does less work. That's the mechanism chain. Data shifts the checklist. The checklist shifts the expected path. The expected path shifts prices. Now, you might ask, why not just cut a little and see? Because credibility is the asset. If inflation is not clearly beaten, early cuts risk a rebound in demand. And the Fed does not want to cut, then hike again. In plain English, they would rather be late than flip-flop. So, what's different about this moment? The market is split between we're fine and we're fragile. That split shows up across assets. When markets believe cuts are near, the front end rallies. 2-year yields fall. The dollar softens. Equities get a tailwind, especially rate-sensitive names. When markets believe cuts are delayed, the front end sells off. 2-year yields rise, the dollar firms. Equities wobble, especially long-duration growth. Credit sits in the middle and decides who feels pain first. Now, bring back our anchor. Sunridge Homes sells houses to normal people. Their buyers care about the monthly payment. Their payment is tied to mortgage rates. Mortgage rates are tied to the path of short rates, plus a spread. So here's what changes from this Fed message. Even if the Fed does nothing today, the market can move mortgage rates just by repricing the cut path. That is why data dependence matters. Now, let's make the objection crusher concrete. Misread number 1 is, if inflation falls 1 month, cuts are locked. Not how it works. The Fed looks for a pattern. One print can be noise. A single good month can move futures. But the Fed wants a sequence. The receipt you can point to is the phrasing itself. Depends on incoming data and risks. That is optionality by design. Misread number 2 is, if the economy is okay, cuts are bad news. Also wrong. Cuts can arrive in a soft landing, or they can arrive in a slowdown. The difference is what happens to credit and earnings while the Fed is waiting. In a soft landing, inflation cools, jobs stay okay, spreads stay contained. In a slowdown, inflation cools because demand breaks, jobs weaken, spreads widen. In plain English, the same cut can mean 2 very different stories. So, how do you tell which story you're in? You watch cross-asset reactions. Here's the simple cross-asset snapshot you should track after each big print. Bucket 1 is rates. Look at the 2-year and the 10-year. 2-year is Fed path, 10-year is growth plus inflation expectations. If the 2-year drops and the 10-year holds, that's cuts without panic. If both drop hard, that's growth scare. Bucket 2 is the dollar. If the dollar falls because the Fed is expected to ease, that can be risk on. If the dollar rises during risk off, that's a funding stress signal. Bucket 3 is credit. Watch investment grade and high yield spreads, even loosely. If spreads are calm, it is a repricing story. If spreads widen, it is a stress story. You can add equities as a fourth bucket, but it's downstream. Now, what could move next and when? Over the next 24 to 72 hours, the story is still interpretation. Fed speakers, headlines, and positioning matter. Markets can overshoot. Over the next 2 to 6 weeks, the next inflation and jobs prints are the catalysts. Each print updates the checklist. If this persists through the next couple months, the pressure point becomes refinancing and bank standards. Not everyone feels it at once. The weak feel it first. Now, a practical walkthrough for Sunridge. In the next 72 hours, they watch Fed funds futures. If the market prices fewer cuts, their line stays expensive. They delay one land purchase. That is a real economy spillover. In the next month, they watch mortgage applications and buyer traffic. If rates don't fall, sales slow. They offer incentives, margins compress. If this persists, they cut starts. That hits jobs in construction and materials. That is how the Fed checklist loops back on itself. In plain English, higher for longer shows up as slower hiring. Now, the why it matters beyond one builder. If the Fed holds longer, the U.S. stays relatively tight compared to others. That supports the dollar. A stronger dollar tightens global financial conditions. It pressures EM funding and it can weigh on commodity demand. If cuts come too early, inflation can reheat. That forces a harsher response later. Markets hate that path. So the Fed is trying to thread a needle. Cut when inflation is truly cooling. Do not cut just because markets want relief. Now, let's turn the checklist into your 3 signals again, with the where to look you can actually use. Signal 1, inflation, official CPI and PCE releases. You watch the core trend. If it reaccelerates, cuts get pushed out quickly. Markets react same day. Signal 2, labor. The monthly jobs report and weekly claims. You watch whether the job market is bending. The lag is weeks. Signal 3, path pricing, Fed funds futures and the implied cut count. You watch whether the market is fighting the Fed or aligning with it. The lag is minutes. That's your map. Next, we close with the stakes ladder cleanly. What to watch this week and what changes first if the story worsens. Now tie it together with the stakes ladder in plain terms. In the next 24 to 72 hours, the biggest risk is a misread. Markets can latch onto one phrase and run. If futures suddenly price cuts sooner without data backing it, that loosens conditions. That is exactly what the Fed tries to prevent with data dependence. In the next 2 to 6 weeks, the real catalysts arrive. 2 or 3 prints can change everything. If inflation cools again and jobs stay stable, the cut path can reopen cleanly. If inflation stalls, the Fed can stay parked longer than markets want. If this persists, the pressure point shows up where rates reset fast. Floating rate borrowers, commercial real estate loans, highly levered balance sheets. Not because of one dramatic event, but because the math keeps compounding. In plain English, the longer high rates last, the more the interest bill matters. That brings us back to Sunridge Homes one last time. If the market pushes cuts out by even a quarter or two, their line stays expensive longer. They build fewer houses. They hire fewer crews. They buy less lumber and concrete. That is the spillover. It is slow, but it is real. Now, here are the exact 3 signals again, so you can track this without getting lost. Signal 1 is inflation trend. Look at the official CPI and PCE releases. If core inflation is cooling again, the Fed has room. If core inflation re-accelerates, the Fed waits. This tends to hit markets the same day. Signal 2 is the job market. Look at the monthly jobs report and weekly jobless claims. If hiring slows meaningfully or unemployment rises, the Fed gets pulled toward cuts. If jobs stay firm, the Fed can hold. This shows up with a lag of weeks. Signal 3 is Fed path pricing. Look at Fed funds futures. If the market prices cuts sooner, conditions loosen. If cuts get pushed out, conditions tighten. This updates in real time. Now, one last calm warning, newsroom safe. The first thing that breaks is not always equities. It is often a corner of credit. If spreads start widening while the Fed is still saying data dependent, That's a sign the real economy is feeling the pause. The second thing to watch is the dollar's behavior on bad news. If the dollar strengthens sharply during risk-off, that can tighten the world. That's when global spillovers accelerate. The third is the curve shape. If the front end stays high while the long end drops, that's a growth worry signal. If the front end drops while the long end holds, that's a cleaner soft landing signal. In plain English, the curve tells you whether cuts are good or bad. So, what happened? Jefferson's cautious optimism kept the Fed in wait-and-see mode. Why it happened? Because inflation progress and labor stability still have to line up. Why it matters? Because the market trades the path, and the path hits borrowing costs fast. What to watch next? Those three signals: inflation, jobs, and Fed path pricing. That's the risk, and that's the recap. If you want the clean signal check, look at those three markers this week. I'll see you in the next one.